Hello, I'm Mohan, a financial advisor helping individuals and families secure their financial futures. I bet you didn't know how crucial choosing the right life insurance can be. Have you ever wondered how your loved ones would manage financially if you were no longer around? It's a tough question to ask, but an important one. We all want to ensure our families are taken care of, even after we're gone. That's where life insurance comes in. It's a powerful tool that can provide peace of mind and financial security for those we care about most. But not all life insurance policies are created equal. There are different types, each with its own set of benefits and drawbacks. Two of the most common types are term life insurance and whole life insurance. Understanding the differences between these two can help you make an informed decision about which one is right for you and your family. In this essay, we'll dive deep into the world of life insurance. We'll explore the ins and outs of term and whole life policies. We'll look at real-life examples and use easy-to-understand comparisons to help you grasp the key differences. By the end, you'll have a clear picture of which type might be the best fit for your unique situation. Remember, choosing the right life insurance policy is not just about numbers and premiums. It's about ensuring your loved ones are protected and can maintain their quality of life, even if the unexpected happens. So let's start this journey together and uncover the facts you need to make this crucial decision for your family's future. Before we dive into the specifics of term and whole life insurance, let's start with the basics. What exactly is life insurance? At its core, life insurance is a contract between you and an insurance company. You agree to pay regular premiums, and in return, the insurance company promises to pay a specified amount of money, known as a death benefit, to your chosen beneficiaries when you pass away. The primary purpose of life insurance is to provide financial protection for your loved ones after you're gone. This money can be used to cover various expenses such as funeral costs, outstanding debts, mortgage payments, or even future expenses like college tuition for your children. It's a way to ensure that your family's financial stability isn't jeopardized by your unexpected departure. There are several types of life insurance policies available, but they generally fall into two main categories: term life insurance and permanent life insurance. Whole life insurance is a type of permanent life insurance. Each of these types has its own set of features, benefits, and costs. The right choice for you depends on your individual circumstances, financial goals, and long-term plans. It's important to note that life insurance isn't just for those with dependents. While it's especially crucial for parents of young children or individuals who are the primary breadwinners in their households, anyone who wants to leave a financial legacy or cover end-of-life expenses can benefit from having a life insurance policy. Now that we've covered the basics, let's delve deeper into the specifics of term and whole life insurance. You need to hear this if you're looking for affordable life insurance options. Term life insurance is often described as the simplest form of life insurance. As the name suggests, it provides coverage for a specific term or period of time, typically ranging from 10 to 30 years. If you pass away during this term, your beneficiaries receive the death benefit. If you outlive the term, the policy expires, and there's no payout. One of the main advantages of term life insurance is its affordability. Premiums for term policies are generally much lower than those for whole life insurance, especially if you're young and healthy when you purchase the policy. This makes it an attractive option for young families or individuals on a tight budget who want to ensure their loved ones are protected during their most financially vulnerable years. Term life insurance is often recommended for specific financial obligations that have an end date. For example, if you have a 30-year mortgage, you might consider a 30-year term life policy to ensure your family can keep the home if something happens to you. Similarly, parents might choose a term that covers the years until their children are financially independent. However, it's important to understand the limitations of term life insurance. Once the term ends, so does your coverage. If you want to continue having life insurance after the term expires, you'll need to apply for a new policy, which will likely be more expensive due to your increased age. Additionally, term life insurance doesn't build cash value over time, unlike whole life insurance. It's purely a death benefit with no investment component. Despite these limitations for many people, the low cost and straightforward nature of term life insurance make it an excellent choice for temporary protection. Whole life insurance, as the name implies, is designed to provide coverage for your entire life. As long as you continue to pay the premiums, the policy remains in force and your beneficiaries are guaranteed to receive the death benefit when you pass away, regardless of when that happens. This lifelong coverage is one of the key features that distinguishes whole life from term life insurance. But whole life insurance offers more than just a death benefit. It also includes a savings component, often referred to as cash value. Part of each premium payment goes towards building this cash value, which grows over time on a tax-deferred basis. The rate of growth is typically guaranteed by the insurance company, providing a level of certainty that you don't get with other types of investments. One of the unique features of whole life insurance is that you can borrow against the cash value of your policy. This can be useful in emergencies or for major expenses like college tuition or a down payment on a house. However, it's important to note that any outstanding loans will reduce the death benefit if not repaid before you pass away. Whole life insurance also offers stability in terms of premiums. Unlike term insurance, where premiums can increase dramatically if you need to renew after the initial term, whole life premiums generally remain level for the duration of the policy. This predictability can be valuable for long-term financial planning. However, it's worth noting that these benefits come at a cost. Whole life insurance premiums are typically much higher than those for term life insurance, sometimes by a factor of 5 to 15 times. This higher cost is the trade-off for the lifelong coverage and cash value component. Let's consider a real-life example to illustrate how term life insurance works. Meet Mike, a 35-year-old software engineer with a wife and 2 young children. Mike is the primary breadwinner for his family, and he wants to ensure they're financially protected if something were to happen to him. Mike as Mike. After careful consideration, I decided to purchase a 20-year term life insurance policy with a death benefit of $500,000. Mike's decision is based on several factors. First, his children are currently 5 and 7 years old. He figures that in 20 years they'll be through college and financially independent. Second, he and his wife have a mortgage with 18 years left on it. The term policy will cover this period, ensuring his family can keep their home even if he's not around. Lastly, the premiums for the term policy fit comfortably within his current budget. Mike as Mike. For the next 20 years, I paid my premiums diligently. The peace of mind knowing my family is protected allowed me to focus on my career and enjoy time with my loved ones. Fortunately, Mike remains healthy and outlives the term of his policy. When the policy expires after 20 years, his children are indeed financially independent, and his mortgage is nearly paid off. Mike as Mike. While I no longer have life insurance coverage after the term ends, I feel comfortable with this. My financial obligations have decreased significantly, and I've built up substantial savings and investments over the years. Mike's story illustrates how term life insurance can provide crucial protection during the years when it's needed most, without the long-term commitment and higher costs of whole life insurance. It's a strategy that worked well for Mike's specific situation and goals. Now let's look at a different scenario with Lisa, a 40-year-old small business owner. Lisa has a different set of financial goals and concerns compared to Mike. She's single with no children, but she wants to leave a legacy for her nieces and nephews and ensure her end-of-life expenses are covered. Lisa. After considering my options, I decided to purchase a whole life insurance policy with a death benefit of $250,000. For Lisa, the appeal of whole life insurance lies in its permanence and the cash value component. She likes the idea of having coverage that will last her entire lifetime, regardless of how long she lives. Additionally, as a business owner, she appreciates the financial flexibility that comes with the policy's cash value feature. She sees it as an additional asset that she can potentially use in the future if needed. Lisa. Over the years, I paid higher premiums compared to what I would have paid for a term policy, but I see value in the guarantees provided by the whole life policy. The cash value in my policy grows steadily, and by the time I'm in my 60s, it has accumulated to a significant amount. This gives me options I wouldn't have had with a term policy. When Lisa faces an unexpected business challenge in her late 60s, she's able to take a loan against the cash value of her policy to help tide her over. Later, when she passes away at the age of 85, her policy pays out the full death benefit to her beneficiaries, helping to secure the financial future of her nieces and nephews as she had hoped. Lisa. My story demonstrates how whole life insurance can serve as both a protection tool and a financial asset, providing lifelong coverage and additional financial flexibility. When it comes to choosing between term and whole life insurance, one of the most significant factors to consider is cost. Let's break down the differences in a way that's easy to understand. Term life insurance is generally much less expensive than whole life insurance, especially when you're younger. For example, a healthy 30-year-old might pay $20 to $30 per month for a 20-year term policy with a $500,000 death benefit. The same person might pay $300 to $400 per month for a whole life policy with the same death benefit. Why such a big difference? Remember, term life only provides coverage for a specific period, while whole life covers you for your entire life and builds cash value. You're paying for these additional features with whole life. It's like comparing renting an apartment to buying a house. Renting is cheaper in the short term, but buying gives you an asset that can grow in value over time. However, it's not just about the monthly cost. With term life, if you outlive your policy, you've paid all those premiums and get nothing back. With whole life, even if you live to be 100, your beneficiaries will still receive the death benefit when you pass away. Plus, you have access to the cash value while you're alive. This cash value grows tax-deferred and can be a valuable financial tool. Another factor to consider is the level of the premiums. Term life premiums are typically level for the duration of the term, but if you need to renew or buy a new policy after the term ends, the premiums will be much higher based on your increased age. Whole life premiums, while higher, generally remain level for life. This predictability can be valuable for long-term financial planning. Ultimately, the choice between term and whole life often comes down to your specific financial goals, budget, and life circumstances. Section 8, the cash value component. One of the key features that sets whole life insurance apart from term life is the cash value component. But what exactly is cash value? And how does it work? Think of cash value as a savings account built into your life insurance policy. A portion of each premium you pay goes into this account, which grows over time on a tax-deferred basis. The growth of your cash value is typically guaranteed by the insurance company, although the rate of growth can vary depending on the policy. Some policies also pay dividends, which can be used to increase your cash value or reduce your premiums. Over time, especially if you start young, the cash value of your policy can grow to a substantial amount. One of the benefits of cash value is that you can access it while you're still alive. You can take out loans against your cash value, often at favorable interest rates. This can be useful for major expenses like college tuition, a down payment on a house, or even supplementing your retirement income. However, it's important to note that any outstanding loans will reduce the death benefit if not repaid before you pass away. Another advantage of cash value is that it can be used to pay your premiums later in life. Once your cash value has grown sufficiently, you might be able to use it to cover your premium payments, effectively making your policy paid up. This can be particularly beneficial in retirement when your income may be reduced. However, it's crucial to understand that accessing your cash value, whether through loans or premium payments, will impact the overall performance of your policy and the death benefit. Always consult with a financial advisor before making decisions about using your policy's cash value. Section 9. Making the right choice for your needs. Choosing between term and whole life insurance isn't a one-size-fits-all decision. It depends on your individual circumstances, financial goals, and long-term plans. Let's consider some factors that might influence your decision. First, think about your current financial obligations. Do you have a mortgage, young children, or other dependents? If so, term life insurance might be a good choice to provide affordable protection during these high-need years. On the other hand, if you're looking for lifelong coverage and like the idea of building cash value, whole life might be more appealing. This could be particularly true if you've maxed out other tax-advantaged savings options and are looking for additional ways to grow your wealth. Whole life can also be useful for estate planning purposes, especially if you have a large estate that might be subject to estate taxes. Your age and health are also important factors. The younger and healthier you are, the lower your premiums will be for both term and whole life insurance. However, the difference in cost between term and whole life becomes more pronounced as you get older. If you're young and healthy, you might be able to lock in very affordable rates for a whole life policy that will cover you for life. Your budget is, of course, a crucial consideration. If you're on a tight budget but want substantial coverage, term life might be your best bet. You can get a large amount of coverage for a relatively low premium. However, if you have more financial flexibility and value the idea of insurance as an asset, whole life could be worth considering. Remember, the best choice is the one that provides the protection you need at a price you can afford consistently over time. Section 10. Tips for selecting your policy. Now that we've explored the differences between term and whole life insurance, let's look at some practical tips for selecting your policy. First and foremost, determine how much coverage you need. A common rule of thumb is to have 10 to 15 times your annual income in life insurance coverage. However, your specific needs may vary based on your debts, future financial obligations, and long-term goals. Next, consider the length of coverage you need. If you're primarily concerned about covering specific obligations like a mortgage or your children's education, a term policy that aligns with these timeframes might be sufficient. If you want lifelong coverage or are interested in the cash value component, whole life might be more appropriate. Don't forget to shop around and compare quotes from multiple insurance companies. Rates can vary significantly between insurers, even for similar policies. Be sure to look at the financial strength ratings of the insurance companies you're considering. You want to choose a company that will be around to pay the claim when the time comes. Consider working with an independent insurance agent or financial advisor. They can help you navigate the complexities of different policies and ensure you're getting the coverage that best fits your needs. Be honest about your health and lifestyle when applying for insurance. Lying on your application can lead to your policy being canceled or a claim being denied. Lastly, remember that your insurance needs may change over time. It's a good idea to review your coverage periodically, especially after major life events like marriage, the birth of a child, or buying a home.